Hello, everybody. We're back. I'm Tom Sosnoff. He's Dylan Radigan. Mr. Radigan, how are you?
Greetings, salutations, pleasure. It's an honor to be with you as always.
Is it really?
Yeah, well, quite so. I mean, quite so. I'm a member of the House of Savoy in Italy, so I'm a knighted member of the House of Savoy. And I am a friend of Tom Sosnoff. And those are like my two highest social status signifiers. So
I guess that's quite impressive.
Yeah.
So this morning we're doing the show, and Vanetta brought up a topic, and I mentioned to her that this is the topic that we were thinking of having a discussion on today on Truth or Skepticism. And I don't think I'm blindsiding you at all by this, but I think that it's a fascinating discussion. So Jamie Dimon said yesterday, and this is not about Jamie Dimon, believe me, because I couldn't spend 5 minutes talking about Jamie Dimon, let alone 45 minutes. Said something to the effect of, it's going to take a decade or so, and I'm just paraphrasing, it's going to take a decade or so, because there was a lot more going on in New York yesterday and listening to Jamie Dimon talk. You know, we had the whole world in New York City looking for stories. But in the world of finance, Jamie Dimon said, okay, it's going to take about 10 years or a decade for this entire banking mess to clean itself up. And the first thing that I thought about when I'm reading this is, oh my God, I don't think I've ever read anything more self-serving and almost like, are you playing us? Like, the first thing that went through my head is, oh my God, Jamie Dimon's trying to play us. Because Jamie Dimon to me is the type of guy that every time he has a truly original thought, like, you know, he hates crypto or this or that, I mean, he's so wrong. Like his job, he's good at what he does, which is running JP Morgan, which is... Well,
no, what he does is he accumulates power.
Okay.
He's one of the best in the world at accumulating power, which is given control.
So he's good at accumulating power. What he's not good is talking about topics that he thinks he knows something about, and maybe he does or doesn't, but they always sound horrible. Every time he talks, it scares me, because it just drives me crazy, because he's not that interesting. And the other part to it is everything is very self-serving. So the idea that the banking sector is going to be in disarray or is going to be on wobbly ground for the next 10 years started to get me to thinking, why is he saying this? Because even if I thought the brokerage business was going to be on wobbly ground for the next 10 years, I would never say it, right? Why would I want to scare the children? Like, what's the point of saying, hey, you know what? If you're in the car business, you're not going to come out and say, hey, the car business is going to stink for the next 10 years. Then who's going to buy a car? Or the real estate business is going to stink for the next 10 years. Who's going to buy? I mean, it doesn't make any sense. So, and then all of a sudden, the pieces came together for me. It's Jamie Dimon. Why would he say this? Has to be self-serving in a way. And if you're one of the top tier banks, and obviously JP Morgan is the top of the top tier banks, and all your regional banks are essentially, in a strange way, you need the network. In another way, you know, you want to hurt them, but you don't want to kill them. All that went through my head is, you know what? This is all a move to keep people from moving their money out of the banks that are too big to fail into something that may fail.
Yeah, of course. I mean, again, this is something going back to when the legislation was made in 08, 09 or 9, 10, whatever it was. And there are so many issues with that legislation. But one of the core issues that created these two classes. One class is the Jamie Dimon class, too big to fail, and then the other class is everybody else. And I'm actually surprised that it took 10 years for the regional banks to really become so vulnerable that, you know, if you and I are playing a sport and we're both playing it's like playing with a corked bat. I mean, there's a billion metaphors, right? In other words, all the banks have the same credit problems, what if you want to, just one degree or another, or credit adjustment. Some of the banks have an infinite supply of resources, so they can hide any problems behind the infinite supply of resources. And other banks do not have an infinite supply of resources and are forced to play by the ticky-tack of the accounting rules for the banks that are not too big to fail. It amounts to a federal policy to destroy regional banking and consolidate it with the too big to fail banks, because the same problems that would take 10 years for Pacific West or Western Alliance or whatever these banks are to work out take 1/100th of 1 second for JP Morgan to work out, because they're immediately spooled out into the too big to fail apparatus and disappear.
Yeah, well, it's not, and it's not only a statement about the smaller regional banks and the entire banking system and to move money into the banks that are too big to fail, but it's also a free out. It basically says whatever we did, meaning whatever JP Morgan did or whatever Goldman Sachs did or whatever Morgan Stanley did or Bank of America or Wells Fargo or any one of those big banks, whatever our balance sheet looks like, it's okay.
That's
okay.
The point.
Yeah. It's what's happening at Schwab right now. It's the same thing. I mean, basically, there's 28 billion in losses, but we have plenty of short-term liquidity to cover those losses. So nobody's money's at risk, because there's not going to be a run, because there are no issues, because we have
an infinite supply of money.
Right. We have $1 trillion of liquidity, or whatever it is, hundreds of billions of dollars of liquidity. So what happened at Silicon Valley Bank cannot happen to us here at Schwab, even though we have 28 billion in losses. But if they have 28 billion in losses, what are JP Morgan's losses look like?
Of course.
And how do we get away? And how do we get away with continuing to say, this is the thing that bothers me the most, and this is what I talked about a little bit earlier on air, but what if your earnings, let's just say, what if your earnings are $1 a share? Like, just as an example, your earnings are $1 a share, but you've got $3 a share. You've got $3 a share in losses that you don't, in paper losses, you don't have to report. That the only way you make back you make back quickly is if interest rates go back to zero, which they're not going to go. So
which results in your 10-year workout, which he's saying there's a 10-year workout for the credit.
Yeah, exactly. So in the interim, you have to borrow money at a higher rate than you're collecting on the money just to cover your short-term cash flow needs. But
and now you're 10 years of Japanese subsistence economically, so the stocks don't move and everything. It's a
exactly. But for our business, let's just say if I lose $1 per share for running the firm poorly, and I make $1 per share in revenue, okay, my net number is zero. Okay, so our stock will reflect that zero number. In their world, they push out earnings per share of $1 a share, and they lost $3 a share on unrealized losses, which for some reason don't count.
And that is the brilliance of controlling the Federal Accounting Standards Board if you are a large bank.
Fine, but that's also why you can come out and say something that's as ridiculous as, I don't think the banking sector recovers for the next decade. You know why he says that also? Is because these guys laddered out to 10 years. So they laddered out between 3, 5, 7, and 10 years out. So of course you don't recover for 10 years, because you don't go to back to par. You can't
originate new 10-year risk. I mean, you add new pricing.
You have to wait till you get back to par, and you don't hit par. Right, you don't hit par till 3, 7, 5. Till 3, 5, 7, or 10 years out. And so this whole thing is, of course, then. So what you're doing basically is you're telling the public, okay, the banking sector is on, it's a little fragile, but be careful of those regional banks. And you should probably be in one of the top tier banks because we're too big to fail, even though our losses on a percentage basis are the same as their losses. But we're going to tell you it's going to take 10 years to take care of their losses.
And if you had a coherent government, they would say we can't have two sets of, and really we now have three sets of rules. I mean, the reality is, after the Silicon Valley Bank thing, every single bank in the world, in the country, is backed implicitly, right? The whole thing is a fabrication, I guess, is the reason that the Jamie Dimon thing is frustrating, for the exact reason that you just said. One set of banks can keep their losses out of off-balance sheet and out of their earnings reports. And another set of banks has to do a 10-year workout and be treated like a capitalist gone bad in need of discipline. And ironically, the person admonishing and doing the discipline is the only person who has no adherence to risk loss, whether it's via accounting or in reality. Because even if they lose all the money, they're going to get bailed out.
Yeah, I mean, in hindsight, or maybe not, maybe that's not a good word, but Silicon Valley Bank going under and the whole crisis of, of First Republic and everything else, it actually did these guys a favor, because it exposed it exposed the whole industry, and it almost kind of gives them a free pass.
Well, again, especially look at who you're dealing with. And what's his greatest skill set is accumulating power. So in the chaos of the financial crisis, Jamie was the one with Hank Paulson who was able to get the government to back him to be the guy who's going to sweep up Bear Stearns, who basically becomes the top of the vacuum cleaner of the credit resurrection, was J.P. Morgan and AIG. Right. And so everybody else is scrambling, and Jamie Dimon used that event as an opportunity to get bigger and stronger than he's ever been. Right. Jamie Dimon came out of the financial crisis richer and more powerful than ever before, with the biggest bank in the world, which he didn't have before the financial crisis.
Yeah, that's called opportunity. Agreed.
And for sure, he sees the same opportunity right now, which is, first I got rid of half the investment banks. Now the only people left are Goldman and Morgan. Bear's gone, Lehman's gone, Solomon's been long gone, Smith Barney's been long gone, all these other banks, PLJ gone. And now I'm going to do the same effing thing to all the regional banks in America. Like, in other words, the private meeting, the non-public, even if he's not saying it, the internal lizard brain of Jamie Dimon smells blood in the water. And he's like, I can roll all of this. And I will do it up to the point where it doesn't. And the only reason he doesn't want to do it in a chaos is because it'll affect him. So if they let it spiral into the bank run, and they don't do that intervention with First Republic, and they don't do some of the things that they've already done, then it becomes negative for JP Morgan, because you have chaos in the system. But if you can basically stabilize the regional banks at 90% reduced equity values and paralyze them in a 10-year workout, so now they're not failed, they're just frozen in a 10-year workout with a 90% reduction in their equity value. Now you've teed them up to buy them all.
Well, yeah, they have to keep some. You have to keep the system.
I know. Obviously, they're not going to buy them all. But my point is, now the yard is weak, and you can go shopping.
Yeah, but also you've set an incredible smoke screen for your own incompetence, because. Of
course, that's the brilliant. That's why they call him Jamie Dimon.
Because now you can hide your $100 billion in losses that you've laddered out, that you don't have to disclose, because you've got enough liquidity, because you've taken everybody else's. And yeah, and that's, I think, the story.
That's what he did in 08. He did this once. He did. I mean,
This is the story that everybody's missed. I think this is the whole story. This is at the crux of it. This is it. But unless
Which is not that Jamie Dimon created this problem, by the way. He's just smart enough to see the problem and be like, okay, let's resettle this thing down 90%. We'll buy it all, or enough of it, whether it's by buying it through actual M&A, but more likely through the acquisition of deposits and assets and all the value in the incumbent, to strip the companies from the inside out. It's just, CEO 101.
So.
And he's exploiting an unfair advantage. And so, like, if you have a corked bat, ball's gonna go farther, and no one else is allowed to use corked bats, and you have one.
So why doesn't anybody call him out?
It goes back to the 2008, 9, 10, all that, because there's a the only thing worse than letting Jamie Dimon do this is, one, everybody feels like he's smarter than you are on banking, whoever you are. Warren Buffett's like, I want to read Jamie. So he has a status that is to be unimpeachable by virtue of his track record. And more important than that, they've done a really great job going back to 0809, being the large bank CEOs, of bullying and terrifying the politicians, that the only thing worse than giving me whatever I want and letting me make the rules is having me as your adversary or having me weak, because in that case, it'll be the Great Depression. So you can either let me do what I want, or unemployment goes to 40% and payments stop moving. So it's a hostage situation, which is what it was in 0809, which has then been accepted. And the politicals, no one even goes near it anymore. Even Elizabeth Warren is like, and Bernie Sanders and Rand Paul and, the libertarians, Josh Hawley, whatever, both sides, they don't do it. No one lights up the big banks in any meaningful way. It's like accepting a feudal system. Like, you may not like having lords that control the resources, but that's exactly what you have. And the only thing worse than letting the lord do whatever he wants is to have the lord cut off the flow of resources to the village.
Yeah, I love the topic.
Because I've been we're deep into this over the years. The thing is, it's not true, right? There's such a thing as direct lending, which we actually used so what you could do is you could say, we're going to hold all of the banks to account. And in the disruptive period, we're going to issue direct lending, a la the pandemic, to ensure the flow of credit and payments, to make sure that payroll and everything functions. It's like putting an anesthetic before you do surgery. And what we're doing the anesthetic, but we're letting all the benefits cycle back to the management. I think that the question is, what are the consequences? For me, this lights up a different conversation, but it's related, which is, I feel like we're coming into a period of time, which is the first time I can remember, maybe in 10 years, where whatever the synthetic structure may be, whether it's the bank too big to fail, whether it's all the quantitative easing, or whether it's other super macro factors like 0% interest rates create a sort of distortion in how people behave, because they're just with 0%, like this is like the money machine, like ding, 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 like a borrow zero. And I'm not allocating into other things, or there's infinite distortions. And I feel like we're at a moment where actually maybe enterprise and earnings is going to be relevant for the first time in 10 years. We're coming into an earnings season, and it's not about inflation or rising rates or quantitative easing or war. It's about whether your company is selling widgets. And I actually think that this earnings season will be more interesting than it has been, because I think the story from the managements and their forecasts for this year will be more relevant than they have been in the recent past, because of the diminished relevance of quantitative easing, war, extreme rates, either with the rate of increase of rates or the previous hold on zero. And I'm actually hopeful that that's a positive thing. In other words, at this point, I'm willing to accept the banks are a corrupted system with two classes, and one class is going to try to eat the other class. But either way, the banks have to support economic activity, and I'm interested to see what they're supporting and what's happening in the widget business, whether it's a service or an object.
The funny thing is, with respect to the earnings coming up right now, I look at the bank earnings and I'm like, I actually don't know why anybody would believe anything anybody says. So I look at it as completely different. I don't even understand how they're even relevant.
But I would set aside the bank earnings. My point is, I agree with you that the bank earnings is a hocus pocus anyway, because even if they say what is, if there's a ref in the room with the Fed where it's not a real market.
Yeah,
basically, because it doesn't have real information and it doesn't have real risk. But that doesn't mean that earnings from all the consumer staples, all the consumer cyclicals, all the main Caterpillar, all those earnings that are stories that we haven't even talked about for years, which is like what is actually happening in the consumer staples, which obviously it doesn't change that much. But what is happening in the cyclicals? What is happening in the media? In other words, I think that has been almost of no relevance for a long time. And I'm at least hopeful that this year will be the first year in a long time where earnings will matter. I mean, do you think that the irrelevance of earnings extends beyond the banks?
I would be very surprised
If earnings matter.
if earnings matter. I don't have the same opinion you have. I'd be very surprised.
Why?
Because we haven't rallied enough for earnings to matter. And after the whole banking debacle, I don't know how you can look at earnings and take them at, I don't know how you can assess that much value.
But you're suggesting that Disney or Boeing or Caterpillar's earnings are as weak in their information quality as a bank earnings statement?
Yeah.
Really?
Well, yeah. Why wouldn't they be? Like, I don't understand. Like, I've lost a little. First of all, I've never cared much about earnings because earnings are always kind of like, massaged and tweaked and
it's a production. It's a produced event.
It is a produced event, and even inside of a specific industry, like there's so many different ways that, first of all, you have industry A to industry B to industry C, which all will treat earnings inside of their industry very differently. Like some will have deferred revenue, some will have forward revenue. So there's all these crazy kind of inside of each industry, and then inside of each industry, then so that automatically means there's very little correlation between industry earnings reports, and so the numbers that you see don't really mean anything until the companies actually come out and say something. And then even inside of a specific industry, different firms do it different ways. And so that there's not nearly as much consistency to the reports, to the meaning of the reports, and to how everything's kind of qualified. And so I think people end up hearing what they want to hear, and I think firms end up selling what they want to sell. And ultimately, I think the earnings are a very short-term emotional thing. And I just, of course, earnings can create an outlier. That's all they can do.
Also, earnings reveal macro data like the pace of car sales or the pace of FedEx shipments, UPS, like things that are indicative of aggregate activity.
Yeah, of course. I mean, like
I think have been less relevant recently because of rates and all the other things. That I think. Maybe I'm just hopeful.
Listen,
I would love to see
Facebook
a market that cares about customers.
Facebook has bad earnings, the stock doubles. Tesla has bad earnings, then it has good earnings. I mean, the stock goes up 100 points. I mean, Federal Express has bad earnings, the stock comes back and rallies. Netflix has bad earnings, the stock's $50 higher. Like maybe it's not the next day, but this is. I just think we put way too much of our energies into discussion of earnings, which to me don't really mean anything. Like I said, you can't even match up one industry to the next, let alone one company to the next. So and in the banking industry now, and in the financial sector, like I don't trust anybody. Like, what are you going to do when Schwab comes out with earnings next? And they're sitting on $28 billion in losses on the bank side that they don't have to report on the brokerage side. Like, what do you do now? Like, you didn't know about this last time. Now the stock's 40% lower. So now what do you do? Like, I'm just saying, like, I don't know how you even, I don't even care if you're an analyst and you can write it all up and you make it sound pretty. I don't know what that means.
Yeah, I'm not. I don't
What's the
disagree
next loophole? What's the next
with what
loophole?
you're saying, but I actually believe that there's a pool of information that will be revealed in this earnings season that I think will be more relevant than in the recent past for the reasons that I have said. But I have a different thought, which is, despite your skepticism of the relevance of earnings or the data because of all the reasons and the chicanery and the manipulation and the off balance sheet, I'm thinking about Enron. Remember Enron used all those SPVs?
Sure.
And that was, I mean, when you can take your losses to a different account and not report them, I mean, that is fab. That is solid gold.
Well, I mean, you can't count, there's a difference between fudging the numbers a little and fraud, Yeah,
the difference is whether you have a good enough lawyer at the FASB. But anyway, regardless of all that, earnings has been one of the great onboarding and teaching events for new options traders and new tasty traders, because it's an opportunity to demonstrate, real quick, one day to the next, volatility compression around earnings. And I'm curious whether you feel like that even still holds true. In other words, do you feel like the market reflects your diminished emphasis on the relevance of earnings by virtue of actually not seeing the volatility, expansion, and contraction that you might have seen 5, 10, or 15 years ago around earnings? Like, do you feel like there's less fat on the bone?
There is. I feel like there is.
Okay.
Yeah.
And do you think there's less fat on the bone because your opinion of earnings has been more widely adopted by the marketplace, or because the market's just more efficient in general, so there's just less fat on the bone?
I think the market's more efficient in general.
But you don't think the market has discounted earnings relevance to the degree to which you did in this discussion today?
It would be very difficult. First of all, as an efficient market theorist, it would be very difficult for me to say that. But I do think that in general, the marketplace efficiency has helped to contract expected move. Yes.
Mm-hmm. Other than your personal offense at JP Morgan exploiting his position, which I would actually argue any CEO in that position would do that. If you were the only brokerage that had a direct line to the Fed and didn't have to report your losses and you were too big to fail, it would be logical for you to be like, well, these other brokers are going to have a problem, and maybe you should think about opening an account here.
Actually,
or if I'm the only defense contractor, it could be in any. If I give you special,
that's not what actually bothers me. What bothers me is that if I was in, the reason I think that the problem is a little more is more systemic than other people think, is because if I was a competitor, like we're a competitor to Schwab, I have no problem saying that we have no unrealized losses. Like, do you know what I'm saying? So I have no problem standing on a soapbox and saying, hey, we don't ladder out any of our customer funds.
You're not a bank.
I understand that. But what I don't understand is why if other banks were in a better financial position, I don't know why other banks aren't coming out and saying, hey, you know what? We don't ladder out any money. Like, the reason that I'm concerned.
Well, I've seen some regional bank CEOs say that.
I haven't seen.
M&T Bank CEO came out and was like, these people don't know how to run banks. This is how you run a bank.
Yeah, well, that's great. If somebody said that.
So that's the only person I've seen who said that. But you're making a different point. So go ahead.
That is the point. I would like to see other CEOs come out and say, hey, you know what? That is no way to run a bank. We run a bank. We don't have any unrealized losses. That's
your CEO at M&T. I'm not saying it's any unrealized losses, or at least get long the 2-year as a hedge against your position. Do something at the short end so that you have something, or whatever, whatever it is. But the point is that the government is creating a special status for certain companies in this country, no different than Gazprom in Russia, or Airbus in France, or the large banks in America have a special status.
Okay, we've beaten this. What else you got?
So, again, for me, I actually am enthusiastic that the stock market is going to normalize it. So maybe it's not a discount to your efficient market, but I think the relevance of rates and inflation is going to continue to decline this year, and the relevance of whether businesses have a low cost of customer acquisition, have a high rate of customer acquisition, have expanding margins, have a better widget, whether it's a sales or an object, will be relevant for the first time in a long time.
Okay.
And I think that will make the stock market much more fun, because it'll actually be relevant to have an opinion of a management or a product or a stock price that's more micro analysis, individual enterprise based, as opposed to macro, which I think has driven everything all the time. Which I think is the most fun thing about the stock market. And I know you're going to say, oh, well, it doesn't matter because it's efficient market theory anyway, blah, blah, blah. But I think that the most engaging thing about the stock market is a discussion of, this is Tasty Trade. They have a content marketing plan where they provide free content to people to enroll, to win their trust, to make them customers of their brokerage. You're like, oh, that sounds like an interesting scheme. How's it going? Oh, well, they do a good job of it, and they do it every day. And or this is a biotech company, and it's going to do this, or this is a cruise line from whatever, like that the pleasure of the discussion of the businesses, which I think the most pleasant thing about Wall Street is a window into the attempts of people to do things. And I think that that's been lost a lot the last 10 years. And I think that is great. I think that the hyperstochastic, the sort of super return, the memes and the crypto is great for engagement, to your point, because it's so stimulating and it expands the pool of just basic knowledge. But I also think the relevance of what the companies do is great for engagement. And that when you make what the companies do irrelevant, that you end up with that risk on, risk off culture as opposed to any differentiated market.
So AI is going to bring us all back into the fold.
You're going to have a differentiated market for the first time since 2009.
All because you're going to be able to plop your request into Bloomberg AI, and they're going to tell you exactly what this company does.
I mean, that'll be part of it, but it's also the diminished relevance, the sort of the inoculation to quantitative easing, the through the looking glass on 0% and 5% and the fastest rate, like both sides, the tree, the car accident rates, inflation is bad down to 2% in Spain from 10% 6 months ago. Oil, there's not the oil, whatever the war thing is, it is what it is. Oil moves, whatever. And so now, you throw AI into it. And now I'm like, tell me everything there is to know about whatever. And I think the smaller the company, I think it's probably better for small caps because they have less efficiency, right? You're better in the Russell or with biotech or with whatever startup-y kind of things where there's relevance to that information, which I think will be phenomenal for engagement. I'm not sure what it'll do for returns.
I mean, I think there's probably a little truth to that. I don't think there's a lot. I just don't. I'm sorry. I mean,
why not?
Because I just don't think that's,
But is that because you're just defaulting back to your efficient market thesis?
Of course.
Right,
I mean,
but
listen,
that doesn't mean anything. That's
I understand. I'm just saying, I just don't think people think that way. Like I've been trading for a long time. I don't think that way.
But people do think that way.
Yeah, I know that's what you think.
No.
I'm sorry. I didn't mean to dismiss you, but I
don't feel dismissed. I feel entertained.
Okay. I didn't mean to entertain you then. That was a mistake. But I just don't think it actually works that way.
Mm-hmm.
Yeah. I don't think people research.
You don't think that investors have opinions of the companies that they buy about the merits of the enterprise? You think that it is just you think everybody has an opinion only based on liquidity?
No. I don't think that. But I think I would say as long as I've been in this business, everybody has an opinion based on some form of either their own emotion or somebody else's emotion. I don't think they have an opinion because they did some form of research or they were looking at some form of, a change in macro policy. Yes, I don't believe.
No, but I think people. I disagree with that. People maybe about macro, but micro for sure. People research.
I don't think so.
And they have an opinion of them.
Yeah, I know. I just don't think that. I used to laugh. My stepdad used to.
I'm not saying that they make money doing it, but you can't say that it doesn't exist. It's ridiculous.
Okay, so I'll tell you a funny story. So when I first started trading on the trading floor, this is like in the early 80s, I went home to visit my parents, and my stepdad had this book he bought from, it was a volume of books. It was like encyclopedias. It was from, remember the company called Value Line?
Yeah, of course.
Okay, so it was about as big, it was probably 2,000 pages. Okay, and it was about every company, and there was a whole thing, and Value Line fundamentally broke down every single company.
The Bible of what is a company.
Exactly. And I remember, and he was in our basement. He had an office set up in the basement. And he was reading this Value Line. I go, "What are you doing?" Now I just started trading on the floor, in the S&P pits, and I go, "What are you doing?" And he's like, I'm reading about all these companies because I'm going to invest. He's a fundamental investor, old school, and he goes, "I'm going to put some money in some of these stocks," and I'm just reading about them. I go, and this is 1982, okay, or 1983. I looked at him. I go, "Nobody does that anymore." I go, that's from like the 50s and 60s. Nobody cares about individual companies. It's 1983. All right. Now you're giving me a speech, and this is 40 years later in 2023.
2023.
You're telling me somebody's going to chat GPT, what does blah, blah, blah do? No, not buying it for 1 second. It's not how the world works. It's not how the world works.
And why are there all these asset managers that own publicly traded securities with mandates to be investors in biotechnology?
Because they have mandates to be invested in biotechnology, because they're really good salesmen at putting together funds and fund objectives that make them seem special. That's all it is. It's not. There's no. But that's not
the content. But also the content in those funds and fund objectives is a discussion of how smart and how much research, how all the biotech PhDs that are in the thing, and all of the quality of the analysis they have on the drug pipeline of whatever.
Who cares? It's not no value to that. It's worthless. And now you can chat GPT in 12 seconds. I mean, there's no value to it whatsoever. It's just, listen, it's a fun thing. That's all.
But yes, but you're saying it doesn't exist.
No,
you're saying no one does that anymore.
I mean, no one who seriously invests or trades does that anymore. Sure.
You're saying somebody who's running a $500 million biotech fund or a $5 billion media fund is not serious, even though they're busy jabbering on about the CPMs at Facebook or the CPMs at NB, whatever.
No. Don't get me wrong. They're dead serious, but they only do the research to protect themselves from litigation. And to protect themselves from fraud. They don't do the research because that's what it's a brain dead business. Listen, I'll list fintech in the most brain dead ways I can. The most brain dead business in the world, the dumbest asses, are all bankers. Like, that is the absolute most brain dead business in all of financial service.
Because all management is done to mitigate litigation, whether it's forms.
That's even before that. That's all management is done to meet the minimum level of regulatory requirements. It's not even to mitigate litigation. It's just to meet minimum regulatory requirements. That is the lowest form of life in financial services. It's not even fintech because they don't have any tech. It's banking. And then after banking, okay, we can skip through but we'll get to some of the traditional old school financial service companies. And that part is, then you get to a level where it's kind of like where it's sold product, like fixed annuities or whatever kind of,
all the RIAs,
all the structured products that are out there. Okay. It's not just RIAs, but it's all structured product. That's the second level. That's basically like entry level sales. Again, no fintech, entry-level sales, one notch above banking, but incredibly high fees. The next level is your RIA level. And the RIA level is a little different because that comes on that can be with a large institution, that can be, with an independent company, whatever it is. The RIA level is still 100, well, I shouldn't say 100. It's 98% sales, and it's 2% research to avoid litigation. Okay? This is my cynical view of the world, but so you have low-level banking, which is brain dead. Then you go from low-level banking to fixed products, all right? Fixed any kind of structured product. Then after that, you get into an RIA level, which is mostly sales. So this is where you get the creative salespeople, and then you get creative sales, and then on top of the creative sales, you get a little bit of anti-litigation research, just to protect yourself so that nobody can say you didn't do your research. And then after that, Then you have, your retail traders and your prop firms and everybody else. And that's a whole different animal. That's they're all opportunists. And opportunity comes in a very different form. Opportunity comes in, it's here. It's just like, think about it like a professional gambler. In a professional gambler, nobody says, if you're a Yankee fan, so you're only going to bet on the Yankees. Or, you know what, I only play blackjack. It's the dumbest thing ever. It's not the way the world works. It doesn't happen that way.
But if I have an expertise on analyzing the audience for the media industry and have an opinion, maybe the stock price doesn't help me because that's an efficient market theory, but there's no way I can't know more than you if I'm a media analyst, a media person, than or I can't know more about the pipeline of
you can know more than me. If you're a media person, you can know more than me, but you don't know fraction of what the people in the media business do that also trade those underlyings. So those underlyings don't reflect what I know about the media business, or this is the part that most people don't get. Pick any business. Since you brought up media, we'll pick up media. The people in the media world, if you're talking about somebody like me, I don't know anything about media, so mine's a complete guess. And the analysts know a lot more than I know about the media business if they had to go out and write a book about the media business.
Have an opinion on Disney, let's say.
Have an opinion on Disney. But that opinion has no more value than my no opinion has, okay, or than my no understanding has. But the people that actually do know what's happening in the industry, that are the insiders and the people that work in that industry and the people that really understand the industry.
The head of ad sales at ESPN.
Whatever it is, the head of ad sales at ESPN, the head of lunches at ESPN, I don't care what it is. Those people that really know the guts, they still don't have any idea more than the analysts or more than me. So when it all boils down to it, you have three different levels. You have me, the retail guy that knows nothing. You have the analysts that spend their entire life studying it. And then you have all the insiders that know everything there is to know. And together, all three of us have the exact same idea of what's going to happen next. And anybody that believes differently than that is out of their freaking mind, because it doesn't happen. There's no such thing. So anybody can be, that's what drives me, the concept of expert drives me out of my mind, because there is no such thing as an expert. There is only those three levels, and you can be an expert, you can be a content expert, or you can be a subject expert, but you have no idea where that underlying is going to trade, because the marketplace has already taken all that information, the money flow from me, the money flow and the information from the analysts, and the money flow and information from the insiders, and it has already adjusted the price accordingly.
Yeah, but you're also someone who basically says if you basically disclosed all material non-public information, inside information, and gave it to everybody, they still wouldn't know. You would say if you created a fourth class, which is people who have inside information,
yes,
they don't. Even them, you don't think they stand a chance.
That's right. I mean, there's about 1% of that group which would stand a chance, because it's a fraction of 1% where there is information that would be considered enough to imply an outlier move. Enough
Meaning this company was sold, no one knows.
Well, or this company's about to be sold, no one knows. Or this company's about to
get an FDA approval for their drug, or about to sign a distribution.
Well, you don't even know if you're going to get FDA approval. So even that one's, nobody knows. I mean, it's something probably that's worse than all that, but there are certain situations, but it's a fraction of 1%. So yes, if you said to me, would you be in favor of inside? That's why, like, when people say to me, oh my God, nobody in the Senate should be allowed to trade, in the Senate or the House should be allowed to trade because they know too much. Are you kidding me? They're the dumbest human beings on earth. They should publish everything that they do, just so people can do the exact opposite. Do you know how much money you'd make if you had a fund that did the exact opposite of what everybody does from the Senate or from the House of Representatives? You can invest in the exact opposite of every single thing they do. I do it blind. I'd put an unlimited amount of money in there tomorrow blind, because they're going to be wrong 80% of the time.
With the exception of Pelosi.
I guarantee you over time, Pelosi didn't make a dime. I don't believe, other than what you would have made as a passive investor in an S&P 500 fund.
If only we could run such a test, it would be a pleasure. I believe that people are going to be enjoying analyzing companies once again, and I think it'll be
think that's great,
pleasure.
Dylan.
I bet you it was great. I bet you your uncle quite enjoyed, or whoever your relative was, he probably enjoyed reading about his companies and being like, would I invest in this company and all these things? And I think that it's as much a source of engagement as any speculative fever on GameStop or Ethereum or anything else. I think it's probably the first and most important form of engagement. I'm not sure whether it affects returns. I agree with you that it's probably not relevant to investment outcomes.
I think that for every reason you just said, I think that the Bloomberg GPT is going to be very successful in their own little world, because if for no other reason, people are going to think that exactly the way you think. But
which is now to have better information about XYZ Corporation. And
you are going to have the best information about XYZ Corporation in the world. You are going to know more about XYZ Corporation than any other person ever when you have Bloomberg GPT. But you are not going to have a freaking clue what that underlying is going to do next. But you are going to have the best goddamn information that's ever been given to any investor in the history since the beginning of Value Line. You're going to have it all, but it doesn't mean a freaking damn thing with respect to making money. But we're going to have it. And let me tell you, there's one person who's going to make money from it all. You know who that's going to be?
Mike Bloomberg.
Mike Bloomberg. Everybody else is going to pay Mike Bloomberg. Mike Bloomberg is going to make $100 billion, and nobody else is going to make a dime.
Which is why long ago you resigned yourself to extremity.
So I take it back what I said. If I could buy calls on Mike Bloomberg, I would. That's the only thing I'd buy calls on is Mike Bloomberg.
Okay.
I'm Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. We do this every Wednesday at 1 p.m. Central Time. Please join us next week. Thank you so much, Mr. Radigan.
See you soon, sir.
Goodbye.